Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed, and you can also subscribe to email updates from me over at gregschnell.com. Thanks for there's lots going on that I want to cover off, and thanks for taking the time to listen. And there is a really interesting setup going on as the market is trying to hold up here, but slowly losing its strength. The Endeavor IPO this morning that failed was quite interesting. And it just seems to me that that's how cautious the market is. Even new IPOs can't seem to come to the market right now. So that's really starting to be make things more interesting. Let's start with the agenda. I'm going to cover off advanced decline lines, a little bit about the way I use them. I've learned a little bit about Arthur Hill on them as well. And Arthur does some wonderful work with percentages. And if you're not a full-time subscriber to StockCharts, you've probably missed Arthur's great work in the past. But his work on advanced decline line percentages or advanced decline ratio percentages is phenomenal. Currencies, of course, the US dollar hit a new high yesterday. So we want to cover off the currencies, just take a quick look in there. Gold rolls over, and I like to focus on weekly charts, but in this particular case, it's the 10-week moving average is starting to fail on gold, on the bullish percent index, on the GDX, and on the GDX GLD ratio. So I think big caution there. I know everybody would like, if you're long it, you want to stay long it. I get it. But the one thing to watch for here is just typically when gold gets that weak, could be problematic. FAANG names like Amazon are starting to break down. So I'll show you that chart. And then 9 months gone, where are we in the year? And I think I had a really interesting meeting the other day. We have some money in a locked-in retirement account, and it was being managed outside, and sat down with the person in the meeting, and money's been there for 3 years, but it's underperformed by 30% per year. And I could not help but be disappointed in the way the stocks were being picked and anything like that. And obviously it would be very difficult for somebody to manage money and then have me calling them all the time. So can't really do that. Got to let them roll with the ball, and I've done that. But the funny part was this in the discussion, one of the things that came up, we had tagged the account as high risk investing. So in other words, trying to find momentum stocks and not just dividend payers. The most aggressive stock in the portfolio was something like Visa, and the least not risky, but safe stock, there was 3 Canadian banks in there, and there was 5 pipeline companies and stuff. Anyway, and I said to him, so I flagged this as being risk. What would I get if I had wanted to be cautious? And I couldn't help but think it was almost the same portfolio. So one of the things that just this portfolio model where everything is structured almost the same, and they put your name in a bucket and kind of add all of your portfolio into the bucket, it is remarkable how much you're going to underperform the indexes. Perhaps there's somebody doing something more vivid out there, but out of 35 different assets in the portfolio, I was equally stunned, both by the composition of the portfolio and the impossibility of them outperforming in any sort of manner. So anyway, it was just interesting to have set that up, and obviously we'll probably have to change how that money's managed now. But I thought that was an interesting story to just share. It is very difficult to try and find people managing money technically that are using a little bit more aggression. So anyway, with that, I want to show the advanced decline line, and I've shown it a couple of different ways here. And one of the things that comes up, maybe I'll just shrink the screen a little. One of the things that I like to show on here is this. Down at the bottom is the raw data, and obviously just the raw data, I don't know about you, but I can't find any trend in that. So that's a bit of a problem. So then we move up to the second box here from the bottom, and this is the advanced decline line. And the way this is measured out is called cumulative. And when we look at the advanced options here, so I've set it up as cumulative and put it in blue, and the height, by changing the height to 1, this box size becomes the same size as my main indicator. So what we see on this cumulator, on a cumulative approach, is it takes the net difference between the advanced decline line from the previous day and adds it to the new day. So out of, let's just pick random numbers, out of 4,000 stocks, if 3,000 are going up and 1,000 are going down, you're going to add 2,000 to this list. It's not usually that big a swing, but obviously that's the kind of swings you see off the lows here when things just really start to accelerate. So here what we had was we had a trend line breakout back in early September, and things looked extremely bullish. JP Morgan was breaking out, a whole bunch of stuff was starting to fly. Energy was starting to turn up, industrial metals were starting to turn up, and a lot of this was on the back of the China trade talks. And so there was a huge surge in optimism. And one of the problems with that surge now is we have actually broken back down again. And the reason I think this is so important is when we wind out the chart, this is one of the reasons that you want to be a member and try and get more data, because it's the history of the data that helps. I need to go one more year. What you can see on this chart is that back here in 2014, you can see that the NASDAQ advanced decline line was declining, and it can decline. It typically does not. It has a lot of tech stocks in it, so it typically underperforms. But what you see here is in 2015, how it went sideways for a while and then just literally broke down. And what actually happened here was this uptrend. So this uptrend broke, then this uptrend broke, and down you went. So now we had this big giant uptrend. It broke last fall, and now we made lower highs, and we recently made a briefly higher high, but let's just call it the same area. And so to me, it's a lot like we're over in here. And now we can draw an uptrend across the bottom of these points. And if we start to fail here, that would obviously be more difficult. But when these big trends in the advanced decline line fail, I think it's important. And then the other way I look at it here is the 2-week moving average. And one of the things you'll see is when we came off the lows, we literally spent 2 months in positive territory here with a big robust thrust. What we've just done is we had this almost immediate church spire that went straight up and straight down. And look at the high level it made it up to, 600. There's only 3 or 4 of those on this whole chart. And they had a much wider base. They were, 4 weeks, 5 weeks. This was 3 weeks and literally went straight up and straight down. And again, on a 2-week moving average, it literally means it went all the way up and all the way back down right away. So really odd to see that kind of a spike and then no follow through. So that's kind of the interesting position we're in here is, the brief surge we had gave it all back. Now we're sitting on a trend line on the NASDAQ, and I'm just going to revert back to the original setting. I think it was 1 year, was it 2 year? So one of the problems we've got here is we're right on this trend line for the NASDAQ, and we're trying to hold it. And today's obviously important. It's month end, quarter end. So we're going to have a weekly close, monthly close on Monday. And with all of this data coming out here, as we approach the end of the month, do we have the strength? And you might remember last year in September, that was kind of when everything broke. We had this uptrend and all of a sudden it fell apart and down we started to cascade. It is really important to be aware of both these trends and also the trend in your advanced decline line starting to break. I have trouble with the daily wiggles. It doesn't seem to help me. Like in here, as an example, this kind of pulled back for almost 3 weeks and then took off back to the upside. So maybe that's what we get here. But so far, I wouldn't want to see this come down to this dotted line and start to break through. So that's a brief way that I like to look at it. Now let's go on to the next chart. And this is the high-low. Actually, maybe let me just go through to the New York advanced decline line at the same time. So this one looks a little better here. It's been going almost 5 weeks here of staying solid and didn't give it all back. And you can see the advanced decline line for the New York stock market went flat, not down like the NASDAQ. And price action is just stalled in here. Now, the concern we have as we go forward is, do we have enough momentum to break out to new highs? And that's kind of always the question. And one of the things that started to be encouraging was this push here was the biggest thrust we had all the way back since February. So it looked like, we had plenty of momentum to try and get going. And the reality is the last 2 weeks, we've had no momentum. So we're struggling a little bit. When we look at the high lows, so this is the 52-week highs minus 52-week lows, and each day you just have it print a number of them. And one of the problems we have is in a big bull market, like after the Fed meeting and the election in 2016, bing, this thing just shot up and we broke out to a whole bunch of new highs. And then we spent a year and a half up there. Now this year, just look at 2018. Each time, we've made new highs, but again, with very few stocks participating. So these big names have really been carrying the bus or driving the bus. And so one of the concerns I have is this last hump here, up here using a same idea, but in this case, I've got an 8-period moving average. You can just see that, we continue to have deceleration, and I'll just zoom in a bit so you can see that. We continue to have this decelerating where there's less and less stocks making new highs as we make these tops. And like this red line is the NASDAQ composite. And so what we see here is, this is kind of a topping structure. Now we've got a trend line underneath it. If it starts to break down, as technicians, we'd be a little more fearful. Fundamental investors would just say, we're still near the highs. What's the problem? The issue here is we're starting to dip back into negative territory in terms of net new highs. So we're making more new lows than new highs. And what happened back in September of last year was we were just kind of flatlining around zero, and then all of a sudden we started to break down. Well, just this week we started to break down a little bit here. So it adds caution and just makes us pay a little bit more attention. Now, when we look at the same thing for the New York market rather than the NASDAQ market, New York Stock Exchange, you can see we're just kind of pinned around this 100 level. And we had a brief surge in June, July, August that made us start to think that things were going to get better. And now we've just kind of reverted all the way back to where we were. And again, using that same moving average period, we're starting to make a lower high over here. And so this market continues to just try and test and break out. So the New York Composite made its high back in January of 2018, and we continue to just struggle to get through these prior highs. And so far, that hasn't happened. Now, I just want to show the advanced decline percentage that Arthur Hill uses. And so down here, what percentage of stocks out of the 500 in the S&P 500, what percentage are pushing up and pushing down, and then there's a cumulative line for that. So you add the percentages to it. And this broke out to new highs back in early September, but now we've just been waning. And if we use a moving average, you can see we're back below zero again. So we don't have a lot of thrust going on here, and that's the real problem, that as we make this sort of right shoulder, if we're going to break to the upside, we kind of want to start seeing a little bit more pressure from the advanced decline line. I want to take a little bit, so that was a percentage-based one. The other ones were the actual values. Now, I just want to show you the Canadian market for two reasons. One is there's some Canadian viewers, and second is that it's put in a whole different profile. So this is the advanced decline line, and you can see it drizzling lower here. And oil rocketed up for 3 weeks or for a week with Saudi, the oil fields under attack. And so with that, Canada has a whole bunch of oil companies, I think 270 or something. So really a big number of companies, and yet they all surged. And while they were surging, nothing else did. And the concern I have, what that kind of did is hid the actual value of how much progress we were making, because the oil stocks were kind of covering up on the advanced decline line, but it still made a significantly lower high. So the Canadian market broke out to new highs, but we didn't have any real participation in terms of percentage or the number of stocks advancing compared to declining. And when we use the cumulative value, we continue to bump up against this line here. And again, is the line like a real trend line in price? No, it's an indicator. And so it might be high or low. I've just taken a best fit line here. But obviously, if we start to break through this downside line here, that would be significant that we're starting to break down again, much like we did back in September of last year. We're going to take a quick break, cut over to a commercial. We'll be right back, and I'll continue with the rest of the slides. Thanks, everybody. We're going to jump in and talk about the currencies now, and briefly about gold rolling over, and then the FAANG names. Actually, maybe I'll do the FAANG names first, and that's just because it kind of relates to, we're just not getting the lift from the advanced decline line we want, and that's probably because the heavy money here isn't really soaring. So here is Amazon, and we can see, it's starting to break lower here. It's making new 3 or 4 month lows. Here's Apple, and it's been trying to break out, and obviously they had their iPhone release and all that kind of stuff, and they're buying back 75 billion in shares, so the stock is holding up pretty well. But here's Facebook, and it's broken the uptrend much like Amazon. Here's Google trying to get through prior highs. It's not a bad chart. It's just we're still not seeing the uptick. Here's Netflix, and I think we all know that movie's over, or over for the time being. And here's Microsoft, and what we see here is Microsoft is in this very tight wedge, just announced a $40 billion buyback, and it hasn't started to break down. And Adobe has been kind of running lower for 2 months, and yesterday had a nice day, but today giving it back. So we're just seeing these tech stocks not kind of breaking out to new highs, and that's the real problem. If all of a sudden, Microsoft was going to carry us to new highs, it hit one last week and then pulled back right away, tested this uptrend line, so it's in this triangle, and obviously when it reports earnings in middle to end of October, we'll get more data here, but still very worried that these stocks aren't leading, so that's a bit of a problem. Okay, just to go look at the gold chart. One of the things here, I just put a 50-day moving average on here, and I could do it weekly and show you a 10-week, but it's the same idea. We're testing this 50-day moving average, and just in general, when everything is above the 50-day moving average, it's a good time to be on board. And when everything is below, it's a good time to kind of, protect your portfolio. So, and it's commodities, and 50-day moving average is a good level to use for commodity trade. Anyway, here we are just barely holding on to the 50-day, but the gold miners, the bullish percent index for the gold miners has already dropped negative. The GDX is already below the 50-day moving average, was for 2 weeks, briefly tried to get above it and pulled back again. That looks failed to me. And I'd put a horizontal line here at 26 and say if it doesn't hold this, you probably want to be short gold, not long gold. And then the gold miner ratio, typically, you can see when this was trending up, this was a pretty good clue that the gold miners were outperforming gold. That's what that line tells you. And when it's starting to run up, that's a nice place to be on board. We usually see that trend. Now that that's started to dissipate, and we're actually closer to breaking down from that, but we're making lower highs and lower lows. So we've got a high, a lower high, a low, and a lower low. We're starting to make lower highs and lows. That's a concern, and now we're stuck below this 50-day moving average. So it's giving us some clues that the gold trade might not be as romantic as we'd like, and perhaps it's time to just protect the portfolio, or at least start to build your list of things you'd like to buy if it starts to bounce again, but it's not right away. So this is just the 1 month to date, and we're at 3%. I think that's still would be a good month. So you'd be up 36% on the year or whatever. Here we have, by the end of the year, here we have January to now, and we're up 19% on the S&P 500. So that looks pretty good. But again, we were at 18% or something back in May. So, we've had a little bit of improvement, but quite frankly, a sideways market for the last 4 to 5 months. Okay, let's go look at the currencies because I think there's some information in there. I just got to find where I want to do that. I guess right here would be great. Um, so one of the things going on in the currency markets that we need to watch is there's this wedge, and this is looking, it can be bearish if we break downside. Typically, if it builds strength like this and then all of a sudden starts to accelerate, that can be very defining. Now look at how tight this pattern is on the momentum indicator. We have hit our head on this ceiling for, going back to August of last year, then November, and then just keep trying to get the momentum to break out. And then down here we have this uptrend line, and if that was to start to fail, that would be more concerning. Which way this goes is still a question, but again, we're trying to push up to new highs, and so this was yesterday's push, and we'll continue to watch. But as this pushes up here, this is a real concern, and we want to keep watching which way this dollar is going to break. I think if all of a sudden we see the dollar start to move heavy one way or the other, that's really going to coincide with timing of a market either breakdown or breakout. So I think I want to keep watching the dollar for those clues. Now here's the US dollar just in general around this 97.5 line I've drawn on here, and it just keeps hovering above. Martin Pring's special K was uptrending. Now it's still trying to uptrend, but it's a different trend than this green line. Now it would be one more horizontal. The real question is not much momentum, but a little bit of momentum heading higher. Looking at it on the daily basis, you can see this surge, PPO turning up right above zero. That's usually a very bullish place for it to turn up. So as we watch that kind of happen, I think this dollar it is definitely worth focusing on. And the UUP was the one that actually pushed to a new high. But anyway, I think the dollar is worth watching here because there's a lot of clues that could tell us about the overall market. So here's the euro, and what we see on the euro, just make that chart a little larger, is we bump down to new 20-month lows or whatever. As we're breaking down here, might even be 2-year lows, as we're breaking to these 2-year lows, you can see the same sort of pennant pattern that was building on the US dollar in a bullish fashion is sitting here on the euro in a bearish fashion. And if we start to break this momentum trend down, I think that would be another clue that something's changing out there. So just keep watching these currencies. I think, they've been chopping sideways. Like, look at this euro chop for days, just gently trending down, not really giving us, a big trading range that you could trade. Here's zoomed in on a daily chart. You can just see going all the way back here how choppy this has been, and it's literally up for 5, down for 5, up for 5, down for 5. Not a whole bunch of trending. So very short-term trading there for currency traders. I like to watch this Swedish krona to help me with the direction of the euro, and it looks to me like it's still living in the bottom corner. The euro is actually now outpacing it and starting to break lower. So it's not going to help me if it's behind the fact. But here is the British pound, and what we see is Boris Johnson got elected in here, rounded up, and is now rolling back over and is, well, at 2-week lows for sure. The real question is, what about 3-week lows? Wouldn't take much to get there. So look at this PPO histogram sitting here right at zero, and if it was to roll over here, that's a very bearish place. And the other thing about the British pound is it likes to make complex lows. It usually has to double dip a few times in order to really change trend. At this point, I think it still looks weak, and there's a downtrend in the dollar, the pound versus the dollar. So that doesn't look very bullish for the US dollar. So it makes the US dollar more bullish and less for the British pound. So that one doesn't look very good. And Japan, what we see is the yen typically leads gold or trades with gold. And when gold took off, so was the yen breaking out of this big 5-year downtrend, and it's wobbling in here. And what we see this week is it shot up and then pulled all the way back. And I'd call that a reversal candle. We've got a PPO pushing down here on the weekly. And so again, after trying to break out of this pennant pattern, it's rolled over. Now we've got this yellow line that looks like we could start to lose, call it 9 months of momentum on on the yen. So all of these are adding up that they're at very important inflection points, and we see the yen keep hitting its head right on this 95 level. I don't have confidence that all of these other charts are ready to turn enough to help stall the US dollar. It looks more to me like the US dollar is going to go higher. And here's the Canadian dollar drifting lower. And again, we're just stuck around this 75.50 level for all the people starting to try and buy money to go to the US for snowbird season. We're we're stuck right in the middle of the range where we have been for the last year and a half. So no real change. Actually, you can go all the way back to 2016 with a brief moment where you could have bought money a little cheaper. But right now, momentum is absolutely flat, nothing going on. Lastly, let's go to the Aussie dollar. And what we see here on the Aussie is it just keeps drifting into the bottom right-hand corner, kind of like the euro just going down. And so we're not seeing any price action, but that is at new, near new 10-year lows. So hardly expecting a change in any of these currencies to start pushing the US dollar back down. Okay, we've got a few minutes left, so I want to cover off a couple more things. This is I just create a couple of lists here, and this is how all of the industry groups are doing for the week. And what we see is, or the sector groups are doing for the week, staples, utilities, and real estate are leading again. Financials are up marginally. That might be just a little bit on the back of Wells Fargo this morning. Trying to hold up there, but technology and semiconductors and industrials unchanged, and then everything like energy, just I would have thought for sure that energy was going to rocket higher on the back of the Saudi strikes, but they had enough oil in inventory to kind of hold things up. Now what I would watch for is just now that the intense pressure of the sudden surge and the pullback is how much our oil reserves going to get drawn down, or can they actually meet it with production? And some of the Russian companies surged the most coming off the back end of that, and some of the refiners, Asia and European refiners, seem to do a little bit better than the US refiners. But in general, I want to watch the oil markets and see which way this whole thing works out. I don't think this trade is over, but obviously it was a sudden surge and pullback. Now we'll watch to see if they base and actually start to improve. Looking around the world, this is the perspective so far this week. In only one market, India, they had some tax changes and stuff, and they had a big push on the back of that. But pretty much everything else is slightly in the red this week. But the Shanghai giving it back again, which isn't kind of what we want to see if that China trade deal is going to start to improve. Looking at the commodities, again, US dollar going higher has really been hit, but these marijuana names just got crushed again this week. They continued to wilt, so not exactly expecting good things there. And for the Canadians in the crowd, our utilities, income trusts, and real estate, just like the US, are leading. The financials are flat, and everything else is getting a little weaker. But healthcare, which is where the marijuana names hide, obviously pulling down quite hard. So materials, industrial materials are weak until we get this trade deal resolved. Gold miners have been pulling back, as I mentioned, and then energy. I thought the bid was going to come in. There was lots of big buying there, and it just seemed to stall. All of that adds up to a weak market here, where we're trying to form the right shoulder of a head and shoulders top, or we have a place where we've consolidated and now we can break out from. And the real question is, I think if we can get a China deal, and I think they're actually coming on October 10th now, we've got a date. So the market might pause here for the next 2 weeks, just trying to wait for that. And if we get a deal there, we'll probably see some acceleration to the upside. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. Thanks again for joining me. Appreciate it. Bye-bye.